Hi everyone, welcome back to Be Rich. I don't know if this video is going to come out on a Saturday or a Sunday. It'll probably be scheduled over this weekend. If I did manage to pull Shashwat in and record a video, maybe this will get pushed to the week. Because it's Pongal week coming up, I wanted to get some of the videos out ahead early, and some of the topics which I thought of talking to you guys, are the kind of topics which we can, of course, record a little ahead because it applies any point of time. And one of these topics which I want to talk about is something which I shared with you on Instagram in the morning, which is the idea of what value investing is and what it means. Value investing is something great in the sense that it helps you realize a lot of things in life. Very few of us, yes, especially when we are younger, don't take the time or pause to see where we are in life. When you start value investing, it suddenly changes your mindset, because in investing, value investing that too, you need to understand where a company has been, where it is right now, where it plans to go, and how much capital you should allocate to this company and hope that it reaches there. And of course, you have a list of 10 companies which you try and target over the period of your value investing horizon, and you hope to get there. So when that mindset happens, what you tend to do is it kind of leaks into all aspects of your life, and you start focusing and reflecting on your life, and your life starts slowing down. Most of us, thanks to social media and the distractions of life, get pulled away and swayed away. But when you do this, you do realize suddenly, you start reflecting on your life and you see the opportunities you've missed so far, what has led you to where you are, where you like to be in the future, and what road can possibly take you there. And like I said, a volatile mind leads to volatile investments. So learning to calm your mind is very fundamental in value investing. Speaking of that, we have come to the year 2025, and I want to give you a kind of a sketch of what's been up, especially you young ones who have been investing maybe since the pandemic, that the last 5 years have been giving you guys fabulous returns, and there have been the good times, because since the pandemic downturn, the Indian market and the global markets have been swinging up, and they've been swinging well. So a lot of you who have entered the market at that point of time really think you know what you're doing, and these markets offer this kind of a return in an average, and it's not true. And that's become very evident this year, especially because not only of what is happening in India, our economy is slowing down, the K-shaped recovery, and we've spoken about this many times. We also have a lot of global change of order happening throughout the world, especially in the United States and in Europe. And this change of order, or change of guard, is going to lead to a lot of friction. Usually when these times happen, in world history, we have seen a lot of friction that comes out of this. So there is going to be some turbulence coming ahead. And when this turbulence comes, you should know the difference between risk capacity and risk ability. What is risk capacity? Risk capacity is what you're willing to take a bet on, what you're wagering in the market. That most of us know what we're willing to put. That's your tiffin coffee range. What is risk ability? Risk ability is seeing that tiffin coffee range turn to zero or becoming illiquid. Illiquid means buying something which you can't get rid of right now. So this is the difference between risk capacity and risk ability, which is something which you should start slowly to engage with and understand. Most of us always have spoken about risk capacity, which is your tiffin coffee range which you're willing to invest, but you slowly have to engage with this prospect this coming year especially. Are you able to accept the losses? Yes, the losses will be short term. They will not be long term. Market will recover, your stocks will recover, especially if you've been buying good quality stocks, it will recover. But will you be able to hold on to it, because it will become illiquid, meaning you cannot sell it. Though market is willing to accept it at a discount, you may not be able to sell it. So this is something which you should keep in mind, and keep your horizons. Long-term horizon is what this year you should focus on. 2 is seeing how your portfolio has been growing. Right? When I always talk about portfolio, all of you just assume I'm talking about equity. But all of us just don't have equity in our books. Our investments have some traditional pieces in it, and it has some equity pieces in it. Most people have around 10% to 15% in equity markets, as in stocks. The rest of them are in traditional assets like FDs, insurance plans, and those things. So if you look at it like that, if the stock market has been giving you an average return of 12-13%, and your traditional investments have been giving you a return of around 5 to 6%, you would be hardly beating inflation at this point of time. So ideally speaking, for you to beat inflation and to see money being in the green, you should be having around 30 to 40% in your equity market. That means, let's say you have X amount of money in your portfolio, which is FDs, insurance plans, your equity should be weighted at least around 30 to 40% for you to be looking at seriously to beat inflation in the long term. Because not everyone can take all their money out of traditional instruments and put it in the equity market, which you should not do, which is understandable. So a lot of you wonder what should be the weightage, what should be the split. So this way, I would say 30 to 40% in equity market should be good, especially if you are young, you can take on this risk. The other thing, what I want you to keep in mind as we get in through this year, because 1 week of this year is already over, 8 days is over. Like I said, we are reaching the last 3 weeks in this month where you can invest. So if you're looking at what to focus on, you should focus on the things you can control. You cannot control market forces, you cannot control geopolitical situations and macroeconomic conditions, but what you can control are 3 things. The 3 things you can control is the amount of money you invest, the time period which you're looking to invest, the horizon as they say, and the third thing which you can look at is what you're investing the money in. Equity, debt, bonds, FDs, what it is. So these 3 things you can control. One is amount of investment, time period and assets. So tend to focus on this, which are what you can control, and not to pay too much attention to things you cannot control, like the forces of the market or Mother Nature. So the last 10 years, let's say the returns have been around 16% on an average, depending on what you've been investing on. That means if you've been sipping around 15,000 rupees and the last 10 years, the annual average return for the stock market has been around 16. That means if you, depending on what you have invested in. So different on large cap, medium cap, small cap, if you take a mix of it all, it's around an average 16%. But this next 10 years, you may not see this kind of return if the geopolitical conditions, like what I said in the beginning of the video, plays out and takes a little longer. Our returns will happen, but may not be to this spectacular level. So let's say you get an average return for the next 10 years going forward around 12 to 13%. So if you sip, let's say 15,000 rupees, younglings out there, you start sipping 15,000 rupees a month, it will take you roughly 30 years to reach 4 crores at 12%. But if you start stepping it up year on year, you can make that 4 crores into 11 crores in the same 30 years. So if you are, let's say, 25, 27 years old, by the age of 55, you can expect to have 11 to 12 crores if you do this. So this is a fundamentally important thing. Not must you only be consistent with your investing, you also need to make sure year on year you look at stepping up your investment. A minimum of 10% is what you should target. I would say even more, because like Anand says, every 3 to 4 years, you should be doubling your salary. At that point in time, your investments should also double. That means your 15 should become 30, your 30 should become 60, and so on. The next thing you should focus on this year, which I want you to keep on mind, is lowering your debt. A lot of you have home loans and you've been asking me, should I close my home loan? I don't want you to close your home loan, but what I want you to do is, I want you to look at paying one extra EMI every year. By paying one extra EMI every year, let's say you have taken a 20-year loan on your house, that will shed your tenor almost by 2 years by the time when you're getting closer to getting it done. So instead of closing the home loan, look at paying at least one EMI extra to lower your debt in the future. So those are the 4 basic things I want you to focus on. Other than that, the things I want you to avoid as we get into Feb, March, April, May is 1, I want you to start avoiding buy now, pay later schemes like my cameraman Arun is suffering from, which is this no cost EMI, where you buy it now and it splits into 12 months, 3 months, 4 months, saying no cost, we'll discount the interest and there's no more cost to you. Don't do that, because you do not know in this current situation, in this current economy, if you'll be able to pay later. So do not do this buy now, pay later. Second thing you should avoid is personal loans. Please do not take on any personal loans. And third thing which I want you to avoid, which is a lot of people, which young ones are trying to do, is take salary advances. There's a holiday coming, there's some festival coming, so I'll take a salary advance and spend it now and worry about it later. Don't do that. And because you do not know what situations are going to transpire in the coming year, so I want you to avoid that. And as far as relying on social media people, it had come out recent statistics that 70% of the stocks recommended by fin influencers have lost money over the last few years. And that should be an astounding number to keep in mind. That should tell you, do not watch videos and buy stocks. Do not watch shorts or Instagrams and buy stocks. This is not the way to buy stocks. Please get yourself a SEBI registered advisor. That is the most reliable way and the correct way to do this. To have a person who knows how to invest and give you a correct strategy and advise you on investing. So This is what I wanted to share with you today as we get deeper into the month of Jan and we exit into Feb. We've already finished 8 days of investing. Those of you who have been doing Tiffin Coffee investing with me on Instagram, we still have another 3 more weeks of investing in Jan. Then we'll get into Feb, where I think we lose a day thanks to a holiday. Other than that, nothing else more to say. Do have a wonderful week ahead of you. Do enjoy Pongal and be safe. Nothing else more to say. It's been lovely having a conversation with you, and I'll see you again soon on another video. Bye.
Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.